Silver is at $72.42 per ounce. That's a 5.6% vertical leap in a single session, on Christmas Eve, when trading desks should be ghost towns. Banks, the perennial shorts, are scrambling to cover millions of ounces, buying at any price to flatten positions before the holiday blackout. Gold sits at $4,500, a threshold that signals fiat erosion, yet silver's gold-to-silver ratio lingers at 62, a distortion screaming undervaluation. This isn't momentum, it's capitulation in a thin market, where bids vanish and prices teleport. The system, designed for controlled suppression, is fracturing right now, exposing the air pockets where liquidity should be. Physical dealers are locking doors, premiums spiking, while industrial chains feel the snap. Control is slipping, and the transfer is underway. I see it unfolding in the order books. Sparse offers at $73, a skeleton crew manning the forts. The banks didn't choose this moment. They were forced into it. Risk managers, staring at open shorts amid geopolitical whispers and supply strains, couldn't stomach the weekend void. A closed market means no escape hatches if news hits, no hedges against a sudden rupture. So they buy, and the price gaps from $69 to $72.42 an ounce. This velocity marks the shift. Sellers turning buyers, funding the very rally they suppressed. Look back to 1980, when the ratio compressed to 17 amid monetary chaos. Silver didn't creep. It exploded as faith in paper crumbled. Today, with gold at $4,500 confirming dollar debasement, silver's lag isn't stability. It's a coiled spring. If reversion pulls to 30, we're staring at $150 per ounce, not as speculation, but as arithmetic inevitability in a system losing its anchors. The fracture lines run deeper, intersecting with industrial veins. Factories don't trade charts, they consume metal. Tesla, Samsung, solar giants like First Solar, their budgets assumed $50 silver for 2026 projections. Now, at $72.42, input costs detonate, margins evaporate. Procurement teams, usually dormant this week, are dialing refiners for off-market locks. 10 tons of paste at $75 flat, premiums be damned. Why? Outage terror, a gap to $80 over the weekend, and production halts. No silver means no panels, no batteries, no output. This inelastic pull vacuum supply from public exchanges, bypassing COMEX vaults entirely. Mines in Mexico reroute output direct to factories, shrinking visible stocks even as prices climb. Here's where the logic bends. Inventories drain not from hoarding alone, but from interception at source. The system, built on just-in-time flows, now faces strategic stockpiles as corporations pivot from cash reserves, losing value, to metal holdings that preserve purchasing power. If you've tracked supply chains in electronics or renewables, how does this procurement scramble look from your vantage? Share your observations in the comments. Does it align with what you're seeing on the ground or reveal different fractures? History mirrors this distortion. In 2011, silver touched $50 as the ratio hit 30, driven by post-crisis distrust and industrial rebound. Back then, banks capped it through paper floods. The mechanism held because liquidity was thick, regulators silent but complicit. Now, that machinery grinds. $4,500 gold exposes the debasement, but silver's suppression fails amid real-world deficits. Mining costs hover at $20 per ounce for primaries. At $72.42, that's $52 pure profit per unit. Cash flows surging without capex spikes. Yet miner stocks lag the metal, up modestly, while fundamentals scream leverage. Wall Street discounts it as transient, but once 72 solidifies as floor, funds chase the yield. This catch-up could double indices in weeks. As free cash turns dividends, debt vanishes. Contrast with 1980s. Hunt brothers squeeze. External force then. Now, it's systemic, with industry as the silent accelerator. The geopolitical threads weave in unnoticed. Supply chains, already taut from tariffs and regional lockdowns, face military overlays. Silver's role in munitions, electronics, stealth tech, a quiet buildup in defense procurement, unreported but inferred from budget anomalies, pulls ounces off market. Regulators' silence amplifies the signal. No interventions, no caps announced, just the void where oversight should stabilize. This absence isn't oversight, it's concession. The market, engineered for fiat dominance, now reveals its brittleness in holiday thinness. Ghost Week looms. Between Christmas and New Year's, volumes evaporate, senior desks vacant. A single whale, Japanese pension say, enters with a market order, devours thin bids, and silver jumps $3 in minutes. Not news-driven, but structural. Empty gymnasiums echo louder. 2008's holiday volatility echoed this, but then it was credit freeze. Now, it's commodity uncoupling from paper. As we trace these interconnections, the physical disconnect sharpens. Bullion sites flash sold out or delays, not mere holiday closures, but risk aversion. Dealers hedge thin, sell at $72 today, gap to $80 Sunday, and restock craters capital. So they halt, creating lockout. Fiat ready, but no metal exchanges hands. This premium divergence, spot at $72.42, physical asks vanished, flags the break. Currency's convertibility falters. In sustainable systems, price equals access. Here, the gap yawns, echoing 1970s stagflation, where gold's rise preceded controls. But controls won't plug this. Industry's hunger outpaces output. Miners ramp, margins balloon, but lead times stretch months, years for new shafts. Short term, it's feast for producers, famine for users. For those in mining or commodities trading, how do these profit windfalls translate to operations? If you're seeing accelerated expansions or bottlenecks, detail it in the comments. Your insights could map the next pressure points. Pushing further, the calendar exerts its pull. January's inflows, fresh budgets, reallocations, historically ignite metals. Funds, pensions, Silver's 2025 outperformance, chasing with billions. A 0.1% slice from a $1 trillion pool? That's demand dwarfing supply. Frontrunners position now, turning December's tail into ascent. Tax dynamics add torque. Year-end selling for offsets, perhaps dumping underperformers like select miners? A dip to $70? Not reversal, but bookkeeping. Shallow, swiftly bought. 2026 budgets assume escalation. CFOs, eyeing inflation's bite? Query. Hold silver as treasury? Apple's billions in cash erode. In metal, they secure chains. This hoarding shift, nascent, could demand billions of ounces, but geology limits. Annual output caps at 800 million, deficits projected 200 million plus. The web tightens with currency signals. Gold at $4,500 isn't milestone, it's alarm. Dollars lost cascades. Emerging markets hoard, central banks accumulate. Silver, dual-natured, amplifies. Monetary haven plus industrial staple. Ratio at 62 defies extraction realities. Silver rare above ground, yet priced as abundant. Reversion isn't optional, it's equilibrium's pull. Banks as shorts, once profitable via manipulation, now bleed. Pain trade higher, feedback looping buys. Where's the ceiling? $75 by year-end, $80 post-holiday. But logic points north. 1980's peak wasn't caprice, it was reset. Here, suppression's endgame plays out, with media blackout as tell. No headlines on $72.42, yet it's the fracture. If you're analyzing monetary trends or historical parallels, how does this ratio distortion stack against past cycles? Weigh in below with your take. Does it signal a sharper compression ahead? Layer in logistics, wholesalers offline, transport idled over holidays. A geopolitical flicker, say, Red Sea reroutes or Arctic claims, snaps links. But markets closed mean no buffers. Asian reopened Sunday night. Pent-up orders hit, gaps form. Shorts surviving Christmas liquidate en masse. This isn't 2011's contained spike. Deficits embed. From solar's 20% silver paste needs to EV batteries surge. Samsung's tech pivot? Symptom of broader scramble. Corporations, once JIT devotees, hoard strategically. Inventory as asset class. Balance sheets evolve, cash dethroned. The system's loss of resilience shows in these pivots. Earlier mechanics, futures hedging, ample liquidity, held because deficits were paper illusions. Now, physical pulls dominate. COMEX drains, vaults echo empty. Miners' windfalls fund expansions, but timelines lag demand. Profit at $52 per ounce incentivizes, yet environmental caps, labor shortages constrain. Stocks, undervalued, await realization. Indices at half potential. Catch-up trades ignite when Wall Street concedes permanence. For investors or analysts spotting minor undervaluations, what's your read on the lag? If you've modeled cash flows at these levels, share your projections in the comments. It could highlight the leverage at play. Unwinding further, the wealth transfer materializes. Banks' surrender funds, holders' gains. Shorts cover, propelling higher. Momentum chasers enter, from contrarian to mania. Volatility spikes, but direction holds. Psychological barriers shatter. $70 ceiling gone, $80 beckons. Thin order books amplify. 50 contracts at $73 versus normal $500. A buy sweeps, price relocates. Holiday history underscores 1929's echoes in thin Decembers, but now it's commodity-led. Geopolitics lurks. Silver's military utility, missiles, radars, pulls in shadow demand. Budget anomalies hint stockpiles, untraceable but inferred from procurement spikes. Regulators' inertia, signal of overload, or tacit admission. Fiat's grip loosens. Media silence compounds. $4,500 gold merits front pages, yet buried. This omission isn't noise. It's the system's attempt at containment, failing. As we connect these dots, the phase clarifies. Not peak, but acceleration. January's wall of money rebalances, inflows, meets dry markets. Pension allocations, even fractional, overwhelm. Front-running builds now, path higher. Tax selling, transient noise, opportunity if dipped. If you've navigated year-end tax dynamics in metals, how do these patterns play out this cycle? Drop your experiences below. Does it create predictable entries or new anomalies? The narrative circles back to the core rupture. Paper decouples from physical. Spot at $72.42, but deals at $75 off exchange. Supply hijacked, inventories illusory. Corporations hoard, miners thrive, banks bleed. History's lens, 1980-2011, shows compression inevitable, but scale amplifies with deficits. Gold's master clock ticks. $4,500 flags debasement, silver follows or breaks the chain. In this unfolding, the system's sustainability erodes. Earlier, suppression masked scarcity. Now, exposure raw. Industrial panic sustains the loop. Secure now or face shutdowns. Miners' leverage multiplies gains, stocks poised. Geopolitical undercurrents pull ounces underground. Liquidity vacuums invite spikes. Holidays as catalysts. For those monitoring global supply or defense intersections, what's your sense of these shadow demands? If silver's military pull is shifting flows, elaborate in the comments. Your view might trace unseen fractures. The process advances. $72.42 not summit, but waypoint in uncoupling. Banks flattened, but industry's hunger persists. January looms as amplifier, fundamentals entrenched. The transfer proceeds, control ceded to scarcity's logic. The market, once tethered, drifts free. Markets close in skeletal mode on Christmas Eve, but the damage registers silently. COMEX registered silver inventories have hemorrhaged over 47 million ounces claimed for delivery in the first 4 trading days of December alone. More than 60% of what was available for the entire system to lean on. Vaults that once buffered paper commitments now echo with withdrawals that cannot be replaced fast enough. Gold vaults bleed in parallel, but silver's drain is the sharper wound because the metal is smaller, tighter, and far more indispensable to the running world. The ratio sits at 62, a number that no longer measures relative value. It measures the width of the fracture itself. This is where the architecture fails in real time. The paper market, built to absorb infinite synthetic supply, now confronts a physical pipeline that has quietly seized. Wholesalers shut doors not for holiday cheer, but for survival. Sell a bar at $72.70 today. Watch Asia reopen Sunday and gap the price to $78, and the replacement cost obliterates capital. So they refuse. Websites go dark, phones stop answering, premiums vanish into call for quote, because quoting would be suicide. The ask side of the market has literally ceased to exist for retail money over the long weekend. Fiat arrives, metal does not leave. That single fact is more damning than any chart spike. If you have ever tried to source physical in size this month, tell me what premiums you were quoted, or if anyone would even quote you. The silence itself is becoming the data point. Look closer at the delivery numbers. December's contract saw notices that would have been considered apocalyptic in any prior year. The exchange raised margins mid-month, not out of routine prudence, but because the velocity of claims threatened immediate operational rupture. They bought themselves days, not resolution. Eligible stocks convert to registered only to be yanked out again, a conveyor belt running in one direction, out of the system and into hands that have no intention of returning it. Minds cannot respond. Byproduct nature of 75% of supply means no one flips a switch when price screams. New primary projects measure their timelines in half decades, not holiday weeks. The ghost week begins now. Senior traders are gone, liquidity providers offline, order books thinner than at any point in the year. A single determined buyer, say, a Korean battery conglomerate securing Q1 needs, places a market order for 500 contracts, and the price simply relocates $4 higher because there is no one left to sell into it. This is not theory. It is the structural consequence of deaths running on skeleton crews, while the rest of the planet keeps burning silver at record rates. Solar installations do not pause for Christmas. Data centers do not idle because Wall Street wants eggnog. The consumption clock ticks while the trading clock is half stopped. And then there's January waiting on the other side. Fresh capital allocations, new fiscal budgets, pension fund rebalances that have watched silver compound 150% in 12 months while their precious metal sleeve sits at zero. They do not need courage. They need compliance with performance-chasing mandates. Even a 0.2% shift from a major fund is multiple years of global mine supply, hitting a market that is already vacuum-sealed. If you are inside a fund or procurement department right now, how are those 2026 budget conversations actually going? Are you still pretending silver is a $50 line item, or has someone already torn up the spreadsheet? The ratio at 62 is the system's confession. Gold at $4,500 reflects monetary debasement everyone can see. Silver at $72.70 with that ratio reflects something more dangerous. The industrial base of the global economy is now competing directly with the financial system for molecules that do not exist in sufficient quantity. Every solar panel installed in 2026, every new EV battery pack, every AI server farm is a bid that cannot be netted out with paper contracts anymore. The metal must physically move, and the paths it can move through are narrowing to a choke point. Dealers are not closed for holidays. They are rationing what remains until they can see where price settles in January, because restocking at the wrong level means bankruptcy. That is not seasonal. That is a market that has entered a new phase where price discovery is no longer about sentiment. It is about who blinks first in a chain of entities that cannot function without the physical. Tax loss harvesting will create noise in the next few days. Miners that lagged will get dumped by funds cleaning books, perhaps dragging spot down to $70 temporarily. It will be the last mechanical dip this cycle offers, bought aggressively by entities who understand that once January capital hits, the concept of resistance becomes academic. The squeeze is not coming. It is already structurally embedded. The shorts who survived Christmas Eve did so only by paying whatever was asked. The ones who wait for the Sunday night reopen will discover that Asia does not celebrate Christmas, and their order books wake up first. Whatever gap appears, then will not be filled by festive goodwill. We are past the point where this resolves quietly. The system has entered the phase where physical removal rates exceed replenishment capacity by a margin that compounds weekly. Every vault report, every dealer shutdown, every off-market direct-to-mine deal is another rivet pulling loose. The market did not break loose on Christmas Eve. It revealed that it was already unmoored, and the holiday thinning is simply removing the last illusions of depth. The transfer continues, molecule by molecule, vault by vault, in the silence that follows the close. If you are sitting on physical acquired below $50, the question is no longer whether the system can hold. The question is how violently it finishes letting go. The vaults are quieter than they should be. COMEX registered silver stocks have surrendered over 47 million ounces to delivery claims in December's opening days alone. More than 60% of the buffer the entire system relied upon for stability. Eligible categories convert, only to vanish into trucks and planes bound for factories and vaults that do not return metal to the exchange. This is not replenishment, it is evacuation. Gold's rise to near $4,500 exposes monetary strain everyone acknowledges. But silver at $72.36 with a ratio compressed to 64 reveals a different fracture. The real economy's grip tightening around a metal it cannot release. The disconnection manifests in the physical layer first. Dealers do not pause sales for sentiment, they calculate survival. A bar quoted at $72 today risks a $78 restock cost by Monday if Asia gaps the market open. Margins evaporate, capital erodes, so inventory disappears behind out-of-stock banners and unanswered lines. Premiums, when quoted at all, stretch to levels that make spot irrelevant. 10%, 15%, sometimes call only, because committing a number invites immediate loss. Fiat tenders arrive in full, yet no ounces depart. This is the point where price signals fail their basic function. Convertibility breaks, and the currency's claim on real assets weakens visibly. Industry does not wait for resolution. Solar fabricators, battery producers, defense contractors, they operate on quarterly imperatives. Q1 2026 production lines demand secured paste and components now, regardless of spot volatility. Off-exchange negotiations accelerate. Direct mine contracts at fixed premiums, entire forward outputs locked for the year. This flow never touches public vaults. It diverts at source, shrinking the pool available for financial settlement. The exchange's remaining stocks serve increasingly as a sideshow, while the primary circuit hardens into bilateral scarcity. Annual mine supply, capped near 800 million ounces globally, faces projected deficits exceeding 150 million for the fifth straight year. Byproduct dominance, 75% tied to base metal economics, means no rapid response valve exists. New primaries require horizons measured in decades, not quarters. The thinness compounds in the trading void. Holiday staffing strips order books to fractions of normal depth. A mid-size order from a sovereign fund or corporate treasury sweeps levels without resistance, relocating price in discrete jumps. Historical precedents exist. Thin December weeks have hosted outsized moves before, but never against this backdrop of embedded removal rates. Asia's sessions lead the reopen. Whatever premium they establish becomes the new reference before most Western desks fully staff. For those tracking institutional flows or corporate hedging desks, how are 2026 allocations shaping up against these levels? If spreadsheets are being rewritten or direct sourcing prioritized, describe the shift. Your perspective could outline the next demand wave. Central banks accumulate gold at record pace, but silver enters national strategic lists quietly. Critical mineral designation alters procurement priorities. Stockpiles form, not for speculation, but continuity. Defense electronics, renewable grids, advanced computing, all embed silver at irreplaceable nodes. Geopolitical rerouting, sanctions, blockades, tariff threats, accelerates this pull, redirecting ounces to reserves that measure security and conductivity, not liquidity. The ratio at 64 is not equilibrium. It is tension unresolved. Extraction realities favor ratios closer to 15 to 20 historically. Yet financial layering sustained distortion for decades. That layering phrase now under sustained physical withdrawal. Reversion does not require consensus. It enforces through absence. Each vault report confirming net drain, each dealer rationing stock, each direct deal bypassing exchanges tightens the coil further. Mining economics invert dramatically at these elevations. Primary producers extract at all-in sustaining costs near $20 to $25. Revenue at $72 yields margins unseen in generations. Cash generation surges without corresponding capex spikes, funding dividends, buybacks, expansions. Yet equity valuations lag, discounting permanence. Recognition lag creates asymmetry. Fundamentals re-rate violently once conviction forms. Leverage compounds as output prices rise, while cost curves remain anchored. The phase transition is underway. Paper claims once absorbed infinite supply through derivative creation. Physical reality now vetoes that mechanism. Shorts cover not from preference, but necessity. Remaining positions face delivery notices they cannot fulfill without bidding higher. The loop self-reinforces. Higher bids draw more claims, depleting stocks further, forcing additional covers. If you follow minor financials or project pipelines, how are these windfalls reallocating capital? Accelerated development, acquisitions, or caution? Your observations could signal the supply response timeline or its limits. Year-end mechanics introduce brief countercurrents. Tax harvesting flushes weak hands, perhaps pressing spot temporarily lower as portfolios cleanse. But the bid beneath absorbs readily. Entities with structural needs view dips as inventory opportunities, not reversals. January's reset brings fresh mandates, performance chasers, rebalance flows, new budget authorizations. Even modest allocations from trillion-scale pools overwhelm annual mine output. The process nears inflection, not because sentiment peaks, but because replenishment capacity collapses relative to removal velocity. Molecules reroute permanently, from financial circuits to operational ones. The market loosens from its paper moorings, drifting toward scarcity's gravity. $72.36 registers the current coordinate, but the vector points unambiguously higher. The system no longer suppresses. It accommodates the transfer already in motion. The break is complete. The question remaining is only the pace of its revelation.